Hi, I'm Mike Elmali, CPA Business Appraiser. In the previous video, I introduced this compound interest formula that can be used to determine how a lump sum present value will grow or accumulate into a specific value. The amount of the accumulated future value, of course, depends upon the size of the initial present value, the number of compounding periods, and very importantly, the interest rate itself. As you will see, the size of the interest rate will always play a very big factor in other applications to which this formula is applied. Since interest rates are such an important variable in these calculations, I thought it would be a good idea to look at how interest rates are established in various economic contexts. In our modern environment, we are thoroughly acclimated to paying interest expense on home loans, student loans, and credit card balances. We're also thoroughly used to receiving interest income on our savings account balances, although lately it has not been very much. It may then strike you as very interesting to realize that charging borrowers any rate of interest on borrowed funds was historically considered a sin in virtually every major religious tradition. Now, why would this be so? Essentially, the idea seems to be that making a loan was considered to be a charitable or fundamentally charitable act, and profiting off of a charitable act kind of defeats the purpose. Now, over time, the idea of collecting interest rate on a debt became more acceptable by invoking the concept of an opportunity cost. So that means that if someone lending you money would have had the opportunity to earn some positive return on those funds in the form of interest income or profit, then it was only fair that the borrower would compensate the lender for the income foregone in the form of interest expense or interest on the loan. Now, in modern societies, the ethical issue has shifted from banning the charging of interest to the enforcement of laws barring excessive interest on the loans. Most countries have upper bound usury laws that prohibit interest rates above certain thresholds. Each state in the U.S. has separate laws prohibiting charging interest at different rates. And the maximum allowed varies by state, but most states set the limits at no greater than 15%, and many set the maximum at far lower levels. Now, unfortunately, there are so many allowable exceptions to these usury laws that for many purposes, these statutes might not as well be on the books at all. Credit card companies based in a state that allows a very high interest rate on credit card balances can charge residents of a state with a lower level at the higher rate. This is why most credit card companies in the United States are able to charge about 18% on unpaid credit card balances. Now, what's really surprising is that there seems to be so little competition on credit card interest rates. Companies do compete on mileage and bonus points, but not so much on interest rates themselves. Now, payday loan and auto loan companies have often worked around the upper limits set by state usury laws. And there has always been pawn shops that effectively avoid state usury laws altogether. And in the bad old days, when organized crime dominated inner city neighborhoods, loan sharking was a very lucrative source of business. The lenders were called shylocks or shies, and the interest rate charged was called the vigorish or the vig. The credit card companies, pawn shops, payday lenders, auto lenders, loan sharks operate to some extent in what you would think would be a free market where market forces of supply and demand would set interest rates, and certainly lower interest rates than charged. But most of these credit extending companies and organizations effectively operate as cartels, keeping interest rates artificially high. Now, perhaps the most important interest rates in modern economies are determined not directly by market forces, but by fiat through the actions of powerful central banks. In the United States, the Federal Reserve Bank, otherwise known as the Fed, sets benchmark interest rates that chartered banks apply in making interbank loans. Interbank loans are necessary when banks have shortfalls in their required reserves and have to borrow from banks who have excess reserves. Now, the Federal Reserve also sets a discount rate, which is the interest rate it will charge when it makes direct loans to chartered banks. The Federal Reserve indirectly impacts interest rates through control of the money supply. When the money supply is expanded, interest rates fall, and when the money supply is contracted, interest rates rise. And the Fed's decisions on setting specific interest rate and interest rate targets are dictated by policy goals designed to keep the overall economy healthy. In the broadest terms, a healthy economy is one in which the currency does not undergo significant inflation or deflation, and the unemployment rate does not reach very high levels. There's a broad consensus that national economies should grow at sustainable rates and avoid excess contractions. Due to the Great Recession of 2007 and 2008, Fed targeted rates have declined significantly over historical averages. The recent COVID-induced economic contraction has forced the Fed to bring down its targeted interest rates to near zero. This lowering of interest rates has brought about all-time lows in mortgage interest rates and commercial lending rates. It has also unfortunately reduced yields on traditionally very safe fixed income investments like CDs and government bonds. Now, given that interest rates can vary widely over time and in different economic contexts, anyone performing time value of money formulas must give very careful thought to the reason a specific interest rate is chosen. Due to compounding effects, even small differences in selected interest rates can produce large swings in time value of money calculations. This table below shows the difference in accumulated future balances over 10 years, starting with a $10,000 balance with monthly compounding. So click here for the next time value of money video.